Good morning and welcome to the Killik podcast for Friday the 12th of June. It's been another week of uncertainty in Greece which has pushed the market around, and last night we saw a negative development in the IFM withdrawal from the process which saw the Greek bank index open very weak, down 8% as people worry about capital withdrawals from that economy. So that's been sitting on sentiment, so it's good to just step back and look at where we are in terms of sentiment, and to do that we look at the American Association of Individual Investors, the AAII, and that's a survey of whether you're bullish, bearish or neutral. And here we can see the level of people who are neutral, neither positive nor negative, is back up to 1988 levels. Now in 1988 the S&P went up 10%, in 1989 the S&P was up 26%. So historically, that's a reasonable entry point into the market when people are this uncertain. Looking at the proportion of the survey who are bullish, that's dropped considerably over the last few months, and that's as the US economy has deteriorated in terms of the macro numbers and this Greek situation has got worse. So again, as an entry point, that's quite a good entry point. So if we look at the median 3-month return following the bullish indicator getting to these levels, it's been around 5.8% rather than 3%, which is the mean return for the following 3 months across that series. So it's a good contrarian indicator. So what's going to get people more positive? Better US data. And this week we saw the May retail sales number come in at 1.2%, which is a good number. And that was reassuring because retail sales is hugely important to the US economy. Early in the month, we also saw the ISM number, which came in with the first uptick since September. So again, we're starting to see better data come in the US economy. I think that will be supportive for shares. If we step back and look at the technicals of the market, this is a process that we look at when we're trying to look at sort of leading indicators to what might preempt a sell-off in the market. And here we've got the proportion of stocks in the S&P that are hitting 52-week highs. Here below you've got a level of around 5%. When it's only 5% of the stocks in the market hitting 52-week highs, you tend to see a breakdown in the broader composition of the equity market. And here you saw it in 2000 through that level, 2007 through that level. Here we're well above that level, very comfortable position. The advanced declines again is an interesting technical indicator, so it looks at the number of stocks in the S&P 500 that have gone up, and you take away the number of stocks that have gone down during the day, and it's a cumulative chart. And here you can see that there's no breakdown in that series, but you saw quite a big breakdown in 98 and equally in 2007 ahead of that rolling over of the market. Again, here's the final one, which is the small cap index, and they tend to be a canary in the coal mine for the broader market because they're more sensitive to growth rates. And again, we're seeing sort of very good momentum in the small cap indices, which gives us faith that the economy is growing, which we're seeing in the macro data, and therefore the market should continue to respond positively. So looking at the week ahead, we've got Ashtead on Tuesday. That's quite a big one. We've also got Barclay Group coming in on Wednesday. On Thursday, Norcross, which is in our smaller cap portfolios, are reporting, and that's about it. So just looking at Barclay Group and the house builders, the house builders have been very strong since the election result, particularly Barclay Group, because they're exposed to the London market, which was at the centre of the policy changes Labour were promoting. So the sector as a whole is now back up to around 2007 levels in terms of outperformance against the FTSE 100. So that's the point where we have a look at the index and we look at the valuations of the stocks and think whether they've sort of gone far enough in the near term. For us, Barclay Group is still very attractive. So here we've got the PE of Barclay Group, and it's sort of matched against the share price since going back to 2004. And here you can see back in 2007, the PE of Barclay Group got to around 15 times earnings. That proved to be a peak in the share price, and we saw a fairly negative period for the shares. Where we are now, even though we've seen some very strong share performances, that P is still only around 10 times. So we feel there's further room for re-rating in that stock, and there's further to go. That's it from me. Thanks for listening. Have a good weekend.